right, yeah. All right, guys, what is going on? Welcome back to another financial trivia. We're on week 8, I believe, with myself and Ryan, as per usual, back another week of trivia in the Kingdom Discord here. Again, covering all things finance, economics, stocks, options trading, you name it, it's on here. 20 questions, 20 seconds for each question, and the winner gets either a free month in the Discord or something else we'll figure out. Obviously, we're still trying to figure out what works for us. So, Ryan, how are you doing, my friend, on this fine evening for me?
I'm doing well. Yeah, yeah, doing well on this nice Saturday afternoon for me at the moment.
And just make sure your audio is being recorded. Just want to make sure I gotta do a mic check here really quick. Make sure we're all set and good to go here.
We are good to go. I'm double checked, but we're good to go.
Okay, because so we got 6 people in here for right now. Everybody knows it. We have a lot of people that come back and do it. They love these trivias every single week. You know, we've gotten a lot of love over the last couple weeks for these ones, so we're gonna keep it coming as we continue to get through it, and we will get right into it. And again, myself and Ryan will have some stupid commentary along the way to make sure we bring some more educational content to you guys, free of charge, of course, as courtesy of joining the kingdom. And if you're watching on YouTube, check out Ryan on YouTube, on After Hours, on wherever else you may find him. Not OnlyFans, most likely, but you can get a free month of, or not a free month, a free week on on Discord and join in here if you'd like to, and then you get to enter into these Kahoot trivia's, I believe.
Yes, you can. No
Is that right?
OnlyFans yet. Maybe eventually.
Yeah, only mans, not only fans. The better version, whatever that means. So so we'll get going with the first question here. So starting off financial trivia week 8, and it just keeps on coming with newer and newer questions every single time. 10 questions from me, 10 from Ryan. First question up, a high short interest and increasing borrowing costs for shorts most directly increases what? This is kind of talking about short interest in a stock, and what does it mean?
I'm glad that you guys
Rock,
are.
thank you for your support, by the way.
Yes, thanks, Rock. And then before you answer that, Genta, I saw you just hopped in. If you want to join, there's a link on the bottom. You go to kahoot.it and you do the game pin on the bottom there. Anyways, go ahead. Explain.
Yeah. Well, I don't really have to explain much because everybody got it right because they keep coming back for trivia's every single week. I feel like we've talked about short interest and how it can cost for, and what the means are for short squeezes. And again, the big short squeezes have been coming since like 2021 era when we had GameStop and AMC back in those time periods. And basically, the idea behind it is when you have high short interest and increased borrowing costs, means that it's going to cost you a lot more to short the stock. And basically, what that means is that if a lot of people are shorting the stock, you have a potential of a short squeeze. A lot of people like to look for short squeezes through the short interest of a stock, which means a lot of people are betting for it to go down. And if a short squeeze starts to unravel, they have to cover their positions, which pushes the price even higher and causes that kind of short squeeze event. So it is a very interesting thing to watch, and I actually love watching it from the sidelines, honestly. Just because I like to see how high it goes. I don't know about you, but I love to watch it. I don't actually take part in them, but
The short squeezes, yeah. I mean, they're hard to. It's hard to find them before they happen.
yeah, a lot of people like to do they like to screen. They have like screeners of like the short interest, the borrow fees, and stuff like that. And when those borrow fees get super high, it's because there's super limited amount of stock left to really short and to borrow for. So that's usually kind of why they get so highly priced up. Like right now, or at one point, I had above foods, and I was getting paid out a lot for lending my shares out because it was such a high short interest borrow rate. Believe it or not.
Nice. I'm sure you were paid a nice penny a month or something, but
I was paid like 40, it was like 40 cents a day actually. So it came out to be like 12 bucks a month. And I also sold my shares off for like $200 in profit, I think I posted in here. So
mm, that's not bad.
didn't do too bad.
What?
Yeah, I put $100 in. I made $300 out like total. So
There you go. I'm sure, Mr. Galaxy, people are borrowing those Beyond Meat shares a lot. But I do want to know how much it costs to borrow Kilver lately. Itai, as you wrote there. I'm gonna guess that meant silver. Um, but if he
interesting.
answers, maybe he won't. Apparently, it's expensive to borrow
Yeah.
silver. I'm okay with that.
Mirage says Webull was 195 last week for interest rate for borrowing shares.
Mm, nice and cheap.
Well, that's probably why also is like since the interest rate's getting so high for them, it's probably why their stock was down 5% because everyone's shorting it. It seems like then if it's a high percent, you know.
Yeah, that's true. All right, we can
Yeah.
do it.
All right. Question. Yeah. Going on to question number two. What is true about dollar cost averaging versus lump sum investing historically? Keyword historically.
This one,
What is true about dollar cost averaging versus lump sum investing? Go ahead, Ryan.
well, this one kind of confused me, but I guess it's a there is caveats in the choices there that I think
Yeah, I know. I think this one might be a little bit of a tough one for sure. Um, so believe it or not, actually, and you know what's crazy is that a lot of people do think that dollar cost averaging beats lump sum investing. That's actually not true. There's a bunch of research articles that have come out that track the how much profit you've made per dollar invested in the market for dollar cost versus lump sum. And it's like 70% of the time, or whatever the number is, it's like something very, very high. Like 70% of the time, basically, is lump sum investing does better than the dollar on a per dollar investment basis compared to dollar cost averaging. Dollar cost averaging reduces the risk and reduces that kind of idea because you can buy at different share prices. But believe it or not, in a rising market, when we have a bull market, essentially, like we've been in for a little bit of time now, even with April's Liberation Day.
like the
Um,
last 10 years,
if
a
you
little bit of time. Go ahead.
Yeah, right. But so a lot of times it's just like having the money in the market, like what Mirage is saying in the chat, time in the market is key. Time in the market versus timing it. Because let's say that like you were waiting to wait for stocks to dip lower after, Liberation Day and they never went lower again. They've been on a straight up moonshot ever since. You would have missed out on all that potential gain potentially as a result of it. So
Mhm.
very, very interesting in terms of dollar cost versus lump sum investing. And again, historically speaking, lump sum actually is always better than dollar cost averaging, but dollar cost averaging reduces your risk. Now it doesn't eliminate volatility will be there no matter what stock you're getting into. There will always be volatility there. That's not going to eliminate it. It might reduce it, but it won't eliminate it entirely, right? So that's kind of some things to kind of keep in mind about. So yeah, fun fact: there is a lot of research behind dollar cost averaging actually does worse than lump sum investing. If you look at the numbers behind it, there's more return and more risk with lump sum. But since markets always go up more than going down, or markets usually go up more than they go down, that risk is usually more worth it than dollar cost averaging. Ryan, fun fact.
Yeah, that's I would have guessed A if I was given this question. So, because
Yeah.
I think like Acorns now, of course, it's their marketing because this is the product that they sell. But like Acorns showed some stupid YouTube ad I saw that was like this person. Now, of course, I'm sure it had to do with the timing thing, but this person put $10,000 in at this year, and this person invested $10 a day, which equaled $10,000 over the last whatever many years. And how much would they have today? And of course, the person who invested repeatedly over time had more money today because they didn't. But I think, I didn't pay attention to the year. It could have been that one person bought at a top. Um, but then also Acorns is trying to get you to use their product, which is to invest repeatedly over time. So of course they're gonna maybe skew it that way too.
Right. And Ty is saying, if you bought at its peak in 2001, it would take you 15 years to get back to even, which is true. Like, I know I saw one thing for Intel where Intel was like, it was like recently, like it's basically back to where it was back in like the early 2000s. But you can't forget, dividends were paid out from Intel, which was really good for you. As having some generation. If you sold options against it to get some premiums on top of it too, that definitely helps as well. So there
Yeah,
are other things that are happening and not just buying the stock and waiting for it to do something. You could sell cover calls against it. You could get dividend payouts for it over the time period.
could sell it.
But yeah, so say again.
You could just get rid of it.
You can just get rid of it too. Yeah, 100%. But definitely one of those things where, again, if you look at how much you've tracked data over the last 100 plus years, historically speaking, again, like you'll see like data behind it where there's more risk adjusted to it from the lump sum, but there's more return and there's less risk for dollar cost averaging, but less return. And since markets usually go up more than they go down, usually it's better to just put the money in the market as soon as you have the chance to do so. So, but it's an interesting question though, for sure. That's why I wanted to bring it up as like a possible question.
As possible, it was a real question. There was no possible in there.
Yeah, you're right. Fair enough. So yeah, again, that's one of those ones that's like a very tough question, where you could think about it in different ways. Not all these questions are going to be like, you might view it differently. If you're somebody who, likes riskier stocks with like a higher volatility like Tesla, it definitely would be better to probably dollar cost average maybe to Tesla because the volatility, you're going to get those big swings in different directions, maybe. Who
It
really knows,
it
right?
I would say Tesla's not a great example just because I mean, I hear what you're saying. Maybe your overall return would have been better, but like it's skyrocketed, and so you're going to benefit either way, depending on when you lump sum invested, right? Like I bought it
Yeah.
forever ago, and I lump summed into it, and it's doing just fine, you know.
Yeah.
But that's not today.
Yeah, 100%. I bought a lot. I have with my HSA account. I bought a lot of SPY and QQQ like a couple years ago,
Smart,
and I haven't like done anything with it. It's just been sitting there, and it's up like 70-80%. So I mean,
excellent.
I'm kind of sitting there nicely.
There you go.
Didn't dollar cost average it. Question number three: what is the difference between selling a naked put compared to a cash secured put? Good question. Hopefully you know this. Plus dividends, exactly. Yep, Mr. Galaxy, you got it. Plus the dividends. So what is the difference between a naked put and a cash secured put? Do you know? This is a Ryan question. So Ryan can take it away.
Yes. So, yeah, the answer is a naked put requires less buying power. So, cash secured put literally means they're going to make you put, the broker is going to make you put collateral of the cash required to put buy the shares. So, if you're selling a put on a $10 stock, if it's cash secured, the broker is going to require you to set aside that $1,000 in collateral. Whereas if it's a naked put, depending on what kind of margin you have, the broker's going to require, unless it's a specific ticker. Some tickers are cash secured no matter what. They're sometimes going to, I laughed at Mr. Galaxy's comment there, but they're going to sometimes make you put up less buying power because it's naked. So, um, it isn't defined risk. I mean, your max loss is defined in that the stock has to go to zero for you to get a max loss. Like it's not infinite like a naked call. So it's not like when I put that as an option because your risk is still considered undefined. They're not the same trade. They're two different things. Yes, physically you're doing the same thing. You're selling a put. You just have to put up less collateral. And a naked put does not limit your max loss. Same reason why it's not defined risk. It's undefined risk. Um,
Yeah, if you open up, if you go to like sell like just a put without having cash behind it on like Robinhood, it will say max loss undefined, or maybe it'll say, or maybe not. I'm trying to remember actually. I don't do
I don't.
naked puts. I don't even know.
I think it says max loss is the
Maybe it does.
negative, whatever the price is minus your
Maybe yeah. Maybe that's what it
premium.
is.
Um, Geo and Delhi, if you guys want to join, there's Kahoot.it, and you enter in the game pin on the bottom here, 180084. We are only on like question 3 or 4, a 3, I think. So get
Yeah,
on in
question three.
here. Genta too, Henta. I don't know if I'm pronouncing that right, or if you're just listening, that is okay too.
Yeah, just dropping off my mother-in-law. Hey, that's okay, Gio. We appreciate you stopping by, anyways. Legend himself in
Yes,
the chat.
I. That is fine, Delhi. I don't
Many
know what
apologies.
WRC is, but yeah, you can multitask if you want to try.
Yeah, absolutely. Make sure again, free of charge for you guys. Kahoot. Okay, nope, not Kahoot in driving. We're not doing that.
Yeah, don't do that. Uh, Jen, I'm just
Just
listening. Hey,
listening.
you're all good, Genta. If I'm saying that right, that's okay. I'll let you know if I win. Yeah, you know,
Yeah,
I'll
man,
do you.
absolutely. We
You
got.
can listen. You can listen.
All right, let's get the next question rolling here then. If
Mm-hmm.
we're good to
Mm-hmm.
go for
Mm-hmm.
now. A company showing a high ROE but low ROIC is likely. Who knows acronyms of a company's financial statements?
Yeah.
Who knows?
So return on equity and return on invested capital.
Yeah, return on equity and return on invested capital.
Yeah, so I bet you
Correct.
unless you read financial statements, no one's gonna know what those acronyms are.
Yeah. Well, but you know what it is though? You know what's crazy is that like I'm putting these on here because the idea behind it is that hey, like when you want to invest in top quality companies, you should know hopefully what ROE is versus ROIC versus all the other ones, because that's how you know your company is going to do very well. You look at them as an undervalued play potentially, like all that kind of stuff. But actually, a lot of people got it right. Actually, 4 people got it right. So congratulations to you guys. Yeah, we're looking at return on equity versus return on invested capital, right? So return on equity is boosted from leveraging debt. So they take out debt, they take out loans, they then use that to grow their company and that kind of stuff. Return on invested capital is money that they have themselves that they're able to go back into investing in the company. So a little bit of a different one, but definitely something that's very important to know is to look at ROE versus ROIC. Definitely something that if you're looking at buying and holding companies long term or just buying leap options in general, if you want to buy a leap on a company that has solid fundamentals, like that's really going to be something that's going to push you over the edge. And I have a couple more questions on here that are based on fundamentals of a company as well moving forward. So,
Mhm. Uh, yeah, fundamentals are, it's good to look at financial statements and stuff like that. Oh, Gary's cat left. I was gonna talk to Gary's cat, but they left. Gary's cat did not want to play. Go ahead.
okay, we'll bring the cat back in at some point. It's all right. I mean, hey, we got what, 15 more questions, 16 more here.
S-
Going on to the next
Yes.
question here, question 5. Oh, look, another one of mine. This is just like what I was talking about. So, having a peg ratio below 1 suggests what? Now, peg ratio, we put a little formula there for you, is the price to earnings divided by the growth. And if it's below 1, what do you think that means for a company? A lot of people actually do peg ratio calculations. I also did them a little bit when I was analyzing a lot of stocks over the summer about what's a good peg ratio and stuff like that. And so
No one wants to
believe
know
it or
what you're
not, a
into,
lot of you guys
Fridge.
actually,
Go ahead.
hey, hey, whoa, 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 take it easy
Go on,
there.
man. Go on.
Yeah, it's really weird why they call it. It's really weird they call it the peg ratio. I mean, it makes sense, price to earnings over growth.
Yeah,
So
yeah, yeah.
couldn't think
It
of
makes
anything
sense.
else, I guess. But
It makes sense. Go on.
but yes, so a peg ratio when you calculate it out here basically is how much they're earning divided by how much they're growing. And if it's below 1, that means that their earnings are a lot lower than their growth potentially have in the company itself, which means that they are looked at being relatively undervalued compared to their expected growth. A bad example, like Barrage put,
Mhm.
Palantir, OKLO, Tesla's always a weird one for sure. Like, because it's like there's like 15 different branches I feel like they're going into now. There's like every other day they're going into something different. But like OKLO is a company which is a really bad one because they have like no revenue and like they're probably if you were to do the peg ratio calculation itself, it'd probably be a super high number, which means that it's ridiculous. Palantir, same thing, very high peg ratio. So when you're buying into companies that have a very high peg, that means that you're buying into a more riskier play that might be overvalued compared to something under 1. Under 1 means that their earnings, their price to earnings is less than their growth they actually have as a company for the future. So definitely something to keep in mind about. A very common thing that people love to trade is the peg ratios when they're buying into companies. Fun
Mhm,
fact.
mhm. Yeah, I mean, and, to be fair, if you bought Oakland Palantir a year ago, you'd be sitting up very nicely right now. Doesn't mean that their VAT might be overvalued or not, but um, yeah,
Mhm.
you know.
Let me tell you, I've thought about selling like call credit spreads or call debit or sell or buying like put debit spreads against OKLO, but it's way too like flipping crazy because it's just like, oh, it's up like 15%. Why? Nobody knows. It's
Yeah,
just like that's the momentum and the hype behind it is crazy. I don't want to get into that one.
no, I wouldn't. That would be I've seen people who like strangle it and stuff. It's not a bus I want to step in front of at the moment.
Yeah, no, for sure. But yeah, so Um, something to keep in mind about definitely again, if you're looking at buying companies, peg ratio, look it up. I believe a lot of websites, you could probably like Google like Tesla peg ratio and it'll pop up or something like that. So you don't have to do the math yourself. You can actually just find it online and use that to help you base your investment also.
Always good to have more factors to weigh in your choices.
Oh yeah, for sure. Moving on to question number 6. If routed for a debit less than the initial credit received, which is not, keyword not, a way to lock in a risk free trade. This is a Ryan question.
You know,
So see if you can debunk this one.
yeah, we'll see. Yeah, this is not an easy one. Uh, it was hard to word it correctly, partly, but I wanted to put it in here.
Yeah, you got
But
this one.
yes. So, okay, so a risk-free trade, when we put on these trades, they're not risk-free in all these situations, right? So the only answer is to close the debit spread in a ratio spread. I mean, number one, I did say to route it for a debit less than the credit received, and to close a debit spread, you have to route that for a credit, just to be fair. But um, yeah, so if you're doing a ratio spread, let's say it's a put, you're short two puts at like 95, and then you're long a put at 90. So to make it risk free, you receive a credit up front when you open that. To make it risk free, you're going to add a new leg at 90. So you're going to buy a new leg at 90. And so if you received a credit of $1 to open it, if you spend less than $1 to buy that wing, it's risk free because you can't lose anything. Because if you received, I don't know how to explain this well, guys. We could talk about this, but I have to like show a drawing here. But like basically, you have two shorts at 95, you have a long at 100, these are puts, and then you have a long, if you buy a long at 90 and you buy it for $50 and you received 100, then no matter what, you got the $50, but if you land in the profit tent, you got your extra income. We'll have to talk about it later. If you buy to close the extra short leg in a ratio spread, so you have two puts that are short, one put that's long. If you buy to close just the one short, then you just left with a debit spread. That's a put debit spread. And then with a broken wing butterfly, I'm trying my best to explain this, guys.
I know. I can't take it seriously with the chat, dude.
I know I can't like focus while I'm looking at all these memes coming up. Um, in a broken wing butterfly, you're basically it's I can't. Forget it. No one cares.
Did you? Did you? Long story short, guys, the answer is the green one. Shut up and we're moving on. All right. Long
Yes.
story short, know
Yes.
your spreads. Come on.
It's okay. It's okay. I need visuals to explain this correctly.
Well, see, Deli, you can explain it because you got it right, Deli. You can explain it if you want. Feel free because you got. I think you got it.
Deli knew what it was because they knew that they can't route it for they have to close this for a credit, you know. I
Of course.
I can explain this to you all. I just need a visual, okay?
Dude, look, you see the poll in the chat.
Yes. I was actually I tutored math in college and I did a very good job, just wanted to say. So
Dude, welcome to the teacher life. And you're like, trying to explain. And it's like looking at you like you have five heads over
well,
here. It's like, all right, guys,
yeah,
we're
I got
moving
like a
on.
whiteboard over here. I was gonna get up and do that, but I was like, you know what? I'm
Could
just
you
gonna.
could you build like it on your app on like your brokerage app and then like put a picture in here while I cover the next question? Would that be better? You think?
I mean, sure. I don't have it. Do I have the image?
All
I
right.
don't
Well, I
have
mean,
any image,
hey,
but hey, they were college kids, Geo, and I did a great job. They all actually enjoyed me as a tutor. Thank you very much.
yeah.
You know, if
I don't know.
anyone really wants to know about it, we can talk about it later, and I'll show you guys.
Or
How's
if anyone
that?
wants to know about it, you can sign up for the mentorship with Ryan as well.
That's
He'll
true.
walk you through that one for sure.
That's
Okay,
true.
do that.
Yes.
All right. Hopefully this next one's better. The difference between the expected return from the stock market and the interest rate from government bonds is called what? This is also, believe it or not, guys, this is Ryan's question,
This
not mine.
is a
I know you
Ryan
think
question.
I know you think it's me. I know
Yeah.
you think it's me. It's actually not. So
I was
Ryan, you can explain this one, hopefully better than the last
Well,
one.
this one doesn't need visuals to explain it correctly. Yes. So the answer is the equity risk premium. Um, Market volatility index, I don't know what that is. I think I had to look up a fake answer from ChatGPT. I don't know what that is. Um, high yield spread is actually the difference between the equity risk premium, the risk free rate, and the risk free rate would be what the interest rate of government bonds is. Um, but the market volatility index probably is the fix. You're probably right there, Tyler. But yeah, equity risk premium. So, the importance about the risk equity risk premium is that if the risk free rate is greater than or equal to the equity risk premium, usually people leave the stock market because they can get a better return that is considered technically as good of a return. It's technically risk free. So it's important to pay attention.
Exactly. You guys all knew that, right? 'Cause I had no idea what that was. I'm not gonna lie to you.
You didn't know? Well, yeah. So this, I actually was starting to dig into it a little bit more lately because it's important with interest rates and everything. But yeah,
Yeah.
basically, if the interest rate in government bonds keeps going up, people are more likely to take their money out of the stock market, and then vice versa if interest rate goes down for bonds,
Right.
just because they can get a risk-free return.
Yeah. No, that definitely makes. Yeah, I guess it makes a lot more sense. I mean, yeah, because I mean it's risk, right? When you're buying into stocks, it's more of a risk. I mean, and bonds are like the government bonds specifically are like backed by the government. So if they can't fulfill their bonds, then we are going to like Armageddon probably or something.
Not, yeah, things are not going well if that happens.
Has there ever been I'm not sure. Would you know this? Do you know if there's ever been a time where like we haven't had anything like that, right? I guess the depression, probably not even the depression though. Yeah, maybe. I don't know actually.
I don't know. I don't know.
Maybe that'll be in next week's trivia.
We'll see.
It's a 4 point difference right now. Isn't that wild?
Whoa.
Wow.
Yeah.
I don't know what Deli just said, but that's absolutely the most sus thing I've ever seen in my life. But I just want
Mhm.
you to know
Oh, he's talking
that.
about the circle, the E ties
Oh,
feature. Yeah. Let's do it.
that's crazy. All right, question number 8. Which of these is not a bullish strategy?
Not.
Not.
What?
This is a Ryan question, and Ryan can explain this one. And you know what? We're only gonna get better from there. Okay, trust me, guys. Let me tell you, there's times where, especially with me, as now I've been teaching for 7 years, there's times where you think you can explain it well, and then it comes out like absolute word garbage, and it
Yeah.
makes no sense. Like
The
it happens to me quite a bit at times, especially my AP class. So don't feel bad about it, Ryan.
the risk-free trade one, that one took me a while to even understand on my own. So it wasn't a great one in hindsight to put in here, but I like want to it's a cool thing to do, so I wanted to point it out. But
Yeah.
anyways, the answer here is short straddle, which most of you got. So short straddle is just selling an at the money put and at the money call. So it is neutral. You don't really want much to happen. Long synthetic stock spread. You're long essentially 100 shares of stock synthetically. So you're bullish because you're long the shares. You can structure this to be bearish though, of course. Call diagonal. You are usually, if it's a call, you're buying an at the money option at a later expiration, and then selling lo- more out of the money call against that. So you're bullish too. So you're like buying $100 call and selling $110 call. So you're bullish because you want it to go up. Put credit spread is bullish because, and no one guessed it, so it's good. But yeah, put credit spread, it's bullish because you benefit from the stock going up or actually staying neutral, but you benefit the most if it goes up.
Yeah. That one definitely is one that makes that one definitely is. I think we should hopefully know these ones for sure. But there's so many different ways of trading options out here. Like you can just do it as however many different ways you want, basically.
True. The only limit is your own imagination.
Yeah, Ryan's out here making like 8 leg like strategies. You know the max. What was one of the trivia ones? Max was what? 4.
Correct. Good memory. Yes, the max is four at a
Yeah.
time. Now, of course, you can route four and then route another tray of four, and you make it essentially eight. But yes,
Just keep
four is
doing
the
it.
max.
And this is why, guys, I want everybody to know here, okay? If you're on YouTube or if you're in the Kingdom Discord here, I want you guys all to know we're not here to spoon feed you stupid questions that are just like, what is this? Like, okay, like we're building new knowledge now. And now that you've been here for a little while, if you have been here for a little while, you know that like we've got the basics down of like what is GDP, what is this. Now we're stepping up the levels here. Now we're getting to more immediate or intermediate level questions here. So keep that in mind.
True. Well, and also, there's we have a limited bank. I mean, it's there's a lot of it's a large well to drain use, but yeah,
Mhm.
you can't keep it too easy for too long.
Question number 9. An inverted yield curve, short rates are greater than long rates, historically signals what? Historically signals. What does it historically signal? I've talked about this quite a bit on my YouTube channel, believe it or not, and probably in Discord too. I think
Maybe in the podcast you've talked about it.
maybe it was a podcast. But yes, this one, and believe it or not, this one isn't like one of those like easy ones essentially per se. But you might be able to think of it basically the idea behind inverted yield curves. Now, I don't know if the 2 year versus the 10 year is inverted still, or I think it uninverted at some point, which people talk about as well. But basically, the idea behind inverted yield curves is that if you borrow, if the short rate has a higher percent than the long rate, that means there's fear in the market because if I want to lock up my money up for longer in treasuries or whatever, if I want to lock up my money for longer, I should get a better return in the long term compared to the short term. And if it's not the case, that's showing that there's a lot of fear and people are flooding to the short term ones, expecting some big catalyst to correct the market or whatever the case really is. So that's really why the inverted yield curves are never really something that's beneficial for us because why would I put my money in for 10 years at 3% if I put my money in for 2 years and get 4%, as an example? Like, I would much rather have my money get a better return for shorter than for longer term. So that's why it's like a very, very, big catalyst of a potential recession that we might have in the near term. Now, near term could be 12 months, it could be 20 months. It's still short term. It's not like you're looking at 5, 10 years. You're looking at, within the next, 12 to 24 months usually. So, fun fact for people that didn't know that.
Sorry,
And a lot of you guys knew it, which is amazing. What happened?
oh, trying to fix my chair here. Anyway, sorry. Good question. I do not know
Yeah,
what I
and
just did.
I'm again. I think what some I've seen some people talk about it also that actually it's not when they invert that you'll see a recession. It's actually when they uninvert is when you might see the actual like recession usually take place. Believe it or not.
Yes, E-Tie, my audio is on.
Question number 10: a company with rising EBITDA, hopefully you know what that stands for, but falling free cash most likely is what? It's earnings before interest, taxes, debts,
Depreciation
and
and amortization.
thank
Come on,
you,
man. I'm the
thank
accountant
you.
here.
Yep, dude, I got 4 of them. Earnings before. I got it.
You got four
I
of the
got it.
6 letters. You're correct. You're correct.
And that's what's up here. So, even though Ryan's the accountant, when I put this question up here, basically the idea behind it is that the money they have all coming in, that means they're having a lot of money coming in before they pay out their employees, before they pay their taxes, before they pay out dividends, before they pay out all those kind of things they're looking at here. And if the cash flow is falling, it's because they're taking a lot of money, they're putting it back into research and development, trying to grow their company even more, right? That's why there's not as much free cash available. They're using the cash they get to then put right back into the company. So it's not cutting research and development. It's actually an increase in research and development ideas and more into capital expenditures, spending a lot of money to grow their companies for the long term. Ryan, anything else to say on that as an accountant?
Yeah, no, I think you're right. Yeah, their EBITDA is rising, but they're spending money. So makes sense.
Yeah, they put it all back in there. You want to have again, those companies that are high growth ones usually do not have a lot of free cash flow, because they're usually using that cash to put back into their company to then grow even more. Usually, when a company starts to stabilize and kind of hit like that like threshold, you might see a lot more free cash flow. Like for example, like Nvidia still has killer numbers, but Nvidia has a lot of free cash flow, so you're not seeing them hit as much, you know beats in earnings, stuff like that, as much as they used to. And it was like 15, 20% moves in NVIDIA as much. Usually a little bit more, a little bit less returns now because they have a lot of free cash flow still, or they have a really big cash flow right now in terms of a company. Basically, what companies should do instead of buybacks, instead of dumb. Yeah, exactly. The buybacks are always so crazy. I mean, sometimes they'll just do buybacks literally when the stock is like the lowest point ever. Like I know like UPS did a buyback recently, or not the company, but sorry, the CEO bought shares. Different. But buybacks are always like the weirdest ones for me, honestly.
Yeah, I think there's
They put
I
their
don't know what the point
yeah,
is.
that's all right. It don't matter.
The buyback, I mean, I think instead of yeah, I don't know. Yeah. Anyways, go ahead.
Like usually if you do a buyback, usually like you're bullish on the company, you wouldn't have bad earnings unless maybe like I think Chipotle was the recent one who did a buyback after their earnings tanked the stock. That was one of the recent ones. It was really
Gotcha.
interesting. They're like, oh, buybacks, and I was like, guys, your stock's down 20% after earnings. You guys missed like everything. And like,
Yeah.
oh, buyback,
Yeah. No,
yay,
trust. Yeah, come on.
yeah, yeah. Trust me, bro. Source.
Yeah.
Oh, stocks only go up, guys. Come on. Question number
Mhm.
11. What option strategy is shown in this profit graph? Oh, I hope you guys can see that or not. I don't know if I can't click on it, unfortunately. I would
I
love
made
to,
it
but
pretty
I mean, it
big.
looks
I
kind of nice.
thought. I thought I made it pretty
Yeah, I
big,
think I think it made it pretty big.
but I don't know.
Short strangle, iron condor, short straddle, iron butterfly.
Yeah. So
Go ahead,
the
Ryan.
answer is an iron condor. So if we pull up the picture. So yeah, it's not a short straddle because the risk is defined because we're buying the wings. So we're buying a put that's further lower than the sold put, and we're buying a call that is further out the money than the sold call. So we're defining our risk. So it's an iron condor because it's basically a put credit spread and a call credit spread. Um, Sorry, everyone gets short straddles. It's definitely not a short straddle, but short strangle would be if we just had the red calls in the bottom. Short straddle would be if the short call and put were at the same strike. And then iron butterfly would just be defined risk of the short straddle, which would be you're putting the at the money call and put sold and then buying wings. But these are all other profit graphs that are gonna, or yeah, profit graphs that are gonna be displayed maybe in the future. Who knows? Because
Yeah, so study up on your trades there.
yes, because this is an easy question to add over and over again every week, everyone. It's hard to find 10 every time.
Yeah, it really is. Really,
So
really is. And we still do
uh,
it every single week.
yeah, you. Sorry for it. I try to make it pretty clear, but if you didn't see it all, I got you. But yeah, green in the middle makes sense. Now with the short straddle, we would see a little bit of a tent, just to be clear. But
Yeah. And if you do a long straddle or long strangle, it'd be the 10, but it'd be the V.
that is
It's
true.
your
It'd
V
be
shape.
like this. That's the one
Yeah,
I
it's
got to
really
remember
good.
those ones. I got to remember putting those in there.
Yeah, right, for sure. Question number 12. A REIT is most sensitive to which macro vector? What is a REIT most sensitive to? This one I feel like may have been a hard one, so I kind of tried to make it a little bit
Well, I mean,
easier with some of the
what is a
things.
REIT? Real estate investment trust.
Investment trust, yeah. Real estate investment trust. Real estate is the hint. Yeah, so I put Fed funds rate, just kind of talk about the idea of interest rates basically. So basically REITs are most sensitive to interest rates because, just like all real estate is in with real estate with interest rates and mortgage rates and leasing and stuff like that. That is usually the biggest, impact of things. People are hoping that, with interest rate cuts, it makes real estate more affordable. People are going to be buying up more real estate because they can get at a lower rate for their mortgages and stuff like that. Same thing with real estate investment trusts, which is REITs, which are very, very profitable as well. They do monthly dividends, but they have to pay out 90% plus of their, I believe it's their revenue, if I'm not mistaken,
Uh,
something like that.
I don't know. I do invest in a one REIT that is hard to get my money out, but yeah, they do give you a nice dividend at least.
Yeah, and Ty says more than inventory sales ratio, and Tyler says yes. The funds rate influences inventory. Yeah, because again, when you have high interest rates, then your inventory is going to be low, right? Because not everyone's going to be wanting to sell their house because no one's going to be buying the house, so you're not going to have as much inventory. When rates drop, you're going to have a lot more inventory in the markets. People are going to be more, optimistic to buy a house at a 4% mortgage compared to a 6% mortgage, which is based on the federal funds rate. Fun fact. And I didn't even do real estate. I just know it.
Are you invested in any REITs?
I used to be into realty for a while. Then I got out of it after a while. That's probably when I was in my dividend portfolio. I used to
Oh,
like
Realty Income.
realty income.
Oh,
Yeah.
yeah. Are they
Oh.
they're are they considered a REIT? There's publicly traded REIT.
Yep.
Okay. Yeah. I,
Yep.
I have REIT. I have that. I have O, and then there's a couple like private ones, but the reason that they're harder is that when you want to get your money out to protect, the SEC has these rules that to protect you. But I've been like trying to get my money out for like a year and a half. It's taking forever. Anyways, doesn't matter. At least I'm
It's
getting
not.
a monthly
It's not through.
dividend.
It's not through. Are you looking? I talking about. You're not through like Fundrise, are you?
I had Fundrise a long time ago, and that one was actually easy to get my money out. But no, I'm in Realty Mogul. I don't know if you've heard of it.
No, I haven't heard of that one. I just know Fundrise, and people would be like, "Oh, I can't get my money out." That's why I thought like Fundrise was the one you were talking about.
No, I had Fundrise and I got my money out actually no problem. The Realty Mogul, because of SEC, they're like, you can only get a maximum of like 25% withdrawn within a quarter. And then on top of that, the SEC limits how much they can withdraw every quarter. So, like, there's a bunch of people requesting withdrawals, I guess, because I get like 25% of my 25% every quarter. So it's been taking.
That's really stupid.
Yes, it will get out when it gets out eventually, but it's just taking.
Interesting. Number 13. What is the name of this candlestick pattern?
Hope people know because I don't can't explain it. So
I think I know this one is.
I'm pretty sure I know which one it is, the answer, but I don't
You
know.
made the, well, yeah, you made the question. I would hope you know the answer to it.
I know the answer, but I can't explain why the other ones are not right. Whoa, I guess I got it wrong. From what I looked up, this was a shooting star, and that the shooting star could be done two ways. So the shooting star could be like this, or it could be a red candle in the middle. But from what I got, and this was from Kingdom University and Googling and everything, that this is a shooting star handle or candlestick pattern. But maybe it's an inverted hammer. I don't know. Maybe they look similar.
I think inverted hammer. I think would be the opposite way. I
Gotcha.
think. I
Well,
think. Like,
I
that's what I thought it was, though. Honestly, was I thought it was inverted hammer also, but
I got this from Candlestick Patterns online and through the Kingdom University. So, um, you know, everyone here, I would think that you guys do your technical analysis and stuff, so you should know these things. But maybe you don't know the name of just because you do technical analysis doesn't mean you know the names of everything. I guess.
yeah,
Um,
that's what's up. Naomi got it right. That's what's up. Only one. Heck yeah, that's what I'm
yeah,
talking about.
good job, Naomi or Naomi. I don't know how to pronounce it. Sorry.
Question number 14. Which of the following is not a benefit of a zebra? And you could probably guess who made this question.
Yep, Fridge did. This is Fridge's question.
Yeah, okay. You think I'd ever make one of these, dude? I really have enough time to freaking open my trades when I'm at school because I get home at like 3:50. I'm scrambling. I feel like at times to
Oh
like
man,
see if there's anything I want to trade into.
yeah, that is not fun. So, um, there you go. The short shooting star, and you had it printed next to you, and you got it wrong. Anyways, going back, the benefit of a zebra. So zebra is a
Stupid
zero
idiot.
extrinsic back ratio spread, right? So, basically, you are buying most of the time when you structure it, you're buying 270 delta calls and selling about an at the money or just out of the money call against that, just one of those. So when you do that, you can you try to be synthetically long around 80, 70 to 100 deltas. So you're basically long 100 shares of stock for a fraction of the cost of buying the stock. Usually you route it for a debit that is much lower than buying 100 shares of stock today. You can structure it to be long or short. So if you wanted to be short, you just do the same thing with puts. So that's a benefit. It's kind of flexible in that way. The goal of it is to remove extrinsic value so you don't really have to worry about theta decay or implied volatility affecting your position too much. It's going to affect the position, of course, but your goal is to be synthetically long. So the requires more buying power than buying shares is the wrong answer because it actually requires less buying power because you're synthetically long or short a position for a fraction. That is
Right.
a zebra.
Love that.
Hmm.
I said he got it right, so I feel like a good jerk right now because I called him an idiot and he got it right.
It
Sorry, Ty.
happens, you know. At least you
Yeah, it
you
happens.
admitted you admitted your mistake. You know.
Oh, dude, he didn't get it right. Oh, you're really a stupid idiot now. I hate you, Ty. You're actually the worst.
The
Felt
funny thing
bad.
is, you
Now I
don't.
don't feel bad anymore.
They should tell us who gets it right here. You know, they should know who's right and wrong.
Yeah. Well, you'll see. Like, if they get it right, their numbers will change. Rather than that, like
That's true. But if people are not the top five,
5. Yeah, I hear you. Question 15. A tax loss harvesting strategy primarily achieves what? What does it mean if you do a tax loss harvesting strategy? This one might be an easy one, depending on if you know taxes or if you know the benefits of doing this, maybe
well, I mean, we talked about crypto being a tax
or
loss
not.
harvesting tool a couple weeks ago, and yeah, it was an
We
easy
did
one. Go
indeed.
ahead
Basically,
though.
the idea behind it is yes, realizing losses to offset gains or defer taxes. And Ryan did accounting, so he could probably add more if he needs to. This one, basically, the idea behind it is that if you've made $5,000 on a stock, for example, and then if you made that within the if you made that, you got to pay taxes on it when you realize those gains, right? So you realize $5,000 in profits, you have to pay taxes on it. But if you sell some stock at a loss, it actually reduces your overall profits you made, and it allows you to pay less taxes on it as a result of it. That is basically the idea behind it. Rock has a
Yes.
question. Drop the question there. Ryan, anything you want to add to it?
Yeah. Only thing, Rock. Yeah, Rock. Driver question. I would say just exactly what you said. Like for example, I have gains on the year. I'm gonna be looking at. I got a couple of stocks that I don't really want to maybe hold on to in the future that are down decent amount. One would be a Moderna, which I have like a $95 cost basis on. So, I might be selling those at the end of the year to help offset my gains. So, yes, it reduces your tax liability in that if you have $100,000 of taxable gains and you sell a couple of stocks for a loss or options trades, then you're reducing your taxable liability or taxable income. How many years after the realized loss, the tax loss not count anymore? Is there a time limit? Are you talking about for rolling forward your capital losses, Rock? Is that what you're talking about? Because when we roll forward our taxable, it's dollar for dollar, Tyler, in calculation. Yeah, your gains are going to offset. I mean, it goes into buckets, right? So you first offset your long term, and that gets offset to a number. Then you offset your short term, and then if there's offset from there, you offset again. Um, So, Rock, your question up to three. Yes. So here we go, everyone. So basically, Rock, let's just say you have $100,000 of losses on your tax return for this year. Let's just say, okay, next year, if you have $100,000 of gains, you can use that full capital loss carryover to offset. Now, let's say you have a $100,000 loss in 2024. In 2025, you have a $0 gain. Well, you can only offset $3,000 every year. But that carryover is forever. That never goes away. So if you have $100,000 of losses, have no gains in the next year, then you can take 3,000 off. You still have $97,000 of losses. Then the next year you have $57,000 of gains. You can offset all 57,000 with your carryover, leaving you with like what, 40,000? So it's into perpetuity until you use the full capital loss. If that answers your question, Rock. Um, I'm not, a tax professional. I took a couple of tax classes. I get the capital stuff, capital gains stuff. But if you want to talk more, Rock, I can talk about your specific situation if you want to. Um,
And if you're realizing $100,000 in losses, what in the heck are you trading?
Hey,
Because good
well,
lord, my friend, that is
some of
wild.
us, sometimes you roll a covered call for a long time,
Yeah,
So,
that's true.
so it's like you're cash ahead, but you're incurring tax losses, right? Um,
Yeah.
but yeah, forward it's into perpetuity as long until you stop needing it. So, there's nothing wrong with, especially if you like, if this year, if you're like, I'm gonna just take some losses to carry over, and then next year you have a bunch of gains, you get to offset it all. I mean, it's kind of nice. So, continue.
Yeah, man, for sure. I'm gonna make a video about taxes. Someone asked me about that in after hours. I'm gonna make a video about taxes, probably break it down more, and do a little bit more research myself with some examples. So
And
be
if
on
you
the
need
lookout
if
for
you need a
that one.
guest,
Question.
lecturer, let me know.
Yeah, I got you. Question 16. In futures, a micro contract is typically blank the size of a standard contract.
Typically, there are some exceptions to this one. I would imagine most of you are going to get this right since most of you do trade futures. The answer is
I do not.
typically yes. So the answer is, I'm going to guess Tyler's the one that said 1/5. The answer is 1/10. Now, there are some exceptions which I did look up to double check. Like I guess micro Bitcoin isn't actually 1/10, and I think maybe micro Ether is not 1/10. But generally speaking, ES compared to MES is going to be 1/10 the size of ES, NQ, GC, silver, whatever, crude oil, natty gas. Pick a ticker, and they're almost always 1/10.
There we go. Love that. I didn't know that actually. I knew
That's
they were
yeah. Well,
micro, but I didn't know the
with
actual fraction
futures,
of
which makes them more confusing, nothing's very much standardized. Period. I mean, you have different tick sizes, you have different notional value or notional like crude oil is 1,000 barrels of crude oil, and ES is whatever. I forget how many, but that's like the only thing in futures that's really standardized.
it. Huh. Good to know.
Yes.
Question number 17. Using the gold future. Wow, more futures, Ryan. GCZ5. What does the 5 represent? Did we do this before?
I did. Well, see, last week we did this with the Z. Now we're focusing on the 5. So,
Oh yeah, and I had that stupid joke I made afterwards. If you remember the stupid joke, you won't pick the same answer then.
well, yes. So, yes, the answer is expiration year. The exchange, hopefully someone just guessed for fun. I don't even, I think I just threw the exchange in there as a fake answer, probably from ChatGPT, because sometimes I can't think of fake ones. Um, Expiration month, that is the Z in this case. The ticker is GC, but yeah, the 5 represents the year. So, coming up here, and actually, if you want to trade futures contract expirations in the future, you're going to see 6s coming up here pretty quick. Now, of course, all of you that use Top Set and all of that stuff, you don't see the Z5. You just see GC most of the time. So, you might not know this, but I wanted to throw it in there anyways.
Yeah, my stupid joke from last time was it's December because that's
Uh,
what the Z stood for
yes,
last
right.
time. And I was like, that's definitely not what it is. Oh man, I see that's. But you know what's crazy though? People are gonna be trading futures and they're gonna see the Z and they're gonna be thinking Fridge's dumbness said December, so they're gonna remember it
Yes,
as that's the month
right.
now.
Now I remember your joke.
Yeah, D's nuts. Exactly. D's
Yes.
nuts. December. That's what the Z stands for. Guys, we're dropping top quality knowledge that is 100% accurate and not wrong. I'll let you know right now.
Yes. Not.
Question number 18. Where are
Yeah.
we at? Question 18. Which option strategy is a ratio spread with defined risk? I remembered the answer from last week because of D's butts. Yeah, you got it, dude. See, everyone remembers it. D's Bember.
So ratio spread with defined risk, huh? All right. So, ratio spread with defined risk is a broken wing butterfly. Technically, a broken wing butterfly is you can do it with calls or puts, but let's just say puts. It's technically a put credit spread that is financing a put debit spread. And usually the put debit spread is narrower than the put credit spread. It's usually wider. But it defines your risk because you're long a we'll use puts. You're long a put, you're short 2 puts, and then you're long another put. And so a ratio spread would just be long a put and short 2 puts. And so you're just defining your risk with the broken wing in that you can't go beyond the max loss of whatever the width of the um, credit spread is plus the gain of the debit spread. An iron condor is a short strangle with defined risk. A call credit spread is a short call with defined risk. An iron butterfly is a short straddle with defined risk. So
And Ryan, keep in mind, if you ever don't know how to explain it, just let me know. I'll just be like, up next. All right, we're moving on.
yes, and no, I should be good if I do it. But yes, Tyler is right. An iron condor, iron butterfly are basically the same thing. The only difference is that an iron butterfly is only the 50 delta ish wings or shorts usually. But yeah, you're technically iron condor, iron butterfly, the same thing, technically speaking.
Yeah, what he said.
Hey, if I put the question in there, Fridge, I appreciate your saying we're gonna go next. If I put the question in there, I usually know how to explain it. I would hope so.
Right. Oh, Ann just joined in. Hey, Ann, how we doing?
Yes. Hey, Anne. Don't think she's playing. She's probably working, but hey, thanks for
And you have
listening.
two, and you get these two questions right, you may have a chance at first place. I want you to know that.
And then Royalty just hopped in. Hello to Royalty too.
Oh, that's what's up.
Now we're gonna use, huh, Tyler?
Super. All right, question number 19. Buying long dated out of the money calls is structurally difficult to profit from primarily because so buying a leap option basically is difficult to profit from
Well, yeah.
primarily because what? I should just put leap honestly. I don't know why I didn't think of that.
Well, out of the money leaps, right?
Yeah, out of the money leaps. Yeah, you're right. Oh, so you always got that one. That's what's up. Yeah. So basically, the idea behind it is that you still have that negative theta decay. You still have theta decay happening against you when you're buying options, which is what people love to have when they're selling options. Theta decay works for you as an option seller, even when you're buying an option. But when you're buying the option, it is going to have theta decay against you instead. And also having a low delta basically means you have a lower chance of profit because you're buying a out of the money call option. So if your delta is say like zero point 0.1, you have, people say, it's a 10% chance potentially of it being at that strike price at expiration, essentially. So you basically kind of shoot yourself in the foot buying an out of the money call option because not only do you have theta coming against you for theta decay, you also have a low delta, which is a low chance of profit as well, I believe. Correct, Ryan, on that one?
Yeah, I mean, the only thing I would say is that, the negative theta, depending on how long dated it is, the negative theta doesn't really play a factor until you get about 3 months out or so, a little bit less than that, probably, but it's still, affecting your position. It's not helping you as days go on.
Yeah, I mean, and I still have like leap options where like I have leap options that it'll, go up like, 0.05% and it might not even move up at all in the option. Even though it's farther dated, it's still losing a tiny bit of value still because obviously those leap options cost you a lot of money. So if you put, $2,000 into a leap option out of the money, for example, you might still lose, 50, $100, which is not a lot in comparison to the entire position size, but it still has a little bit of that decay built in still. So
Yes.
yeah, very unfortunate. And I
Final
think, yeah,
question.
final question. And do
If
we have
we
a chance?
if it even
Oh, we
matters,
do.
it
It's
could
Jackson Smells versus a tie Smells. So
yes.
I don't
Beyond
know who
Jackson
is
has a
it.
chance too. Beyond Jackson's got a chance.
Beyond Jackson has to get the
And
question
Mirage is a Fury.
literally right as soon as it pulls up, and then the other two have to, I think, get it wrong, and then that's how you'll win. I think. I think
Man.
Mirage is a furry actually has a chance too. Believe it or not.
Yeah, I think the top four got a chance. Forward, you might have a shot, but I don't know if anyone can get negative points above you. That's the only issue.
Yeah, I don't know who a tie Smells is or Jackson. I don't know who these people are.
I
I'm not really
think
sure anymore.
I think he ties smells as Mirage.
Okay, could someone in the chat, can you guys tell us who is who so we know who to actually look for? I'm guessing Rock is one of them.
I think Rock is either Jackson or Etai Smells.
Let's find out.
Well,
I gotta know before we get into this.
yes, because I've never got this close. He's all nervous.
Which one are you, Rock? This is a tie smells. Mirage is a tie
Mirage,
smells.
yeah,
Okay,
Mirage
so
is a
let's do.
tie. So Jackson Smells must be Rock. Yeah, he's second place. Okay, here we
Okay.
go.
Ooh, I don't even know what the question is, honestly. I'm nervous for Rock. I want Rock to win, honestly. I would love to have Rock win. He's never gotten this close before,
Well,
but let's see.
neither of them have won before. To be fair,
Yeah, but no one likes Mirage, so it's fine. Like I'm
hey,
rooting
I
for
like
Rock. I'm not
Mirage.
gonna
I
lie to
like
you.
Mirage. Hey
I'm
there,
rooting for
Beast
Rock.
Meat.
I'll throw. Nah, Mirage. Play it seriously. Nah, I don't want you throwing just for that.
No, yeah, yeah, no.
Nah, guys, everybody here who's answering this last question here, please take it seriously. We want a genuine
Yes,
battle here, not some BS of like, oh, I threw for no reason.
yes,
All right.
correct.
All right. Yeah,
Let's do it.
11 people in here that are all watching for the photo
Yeah,
finish and
let's
maybe
add
Beyond
some
Jackson win. I don't
stress.
know.
Let's add some
Yeah.
nervousness.
Yeah. Hey, palms are sweaty, knees weak, arms are heavy. Come on, all that stuff. Eminem. Come on now.
All right, Marshall Mathers.
Yeah. Yo, what
Okay,
is that? Okay, I can't unsee that picture in the chat.
the Will Smith one.
Will Smith drowning in spaghettis.
I think
I
that's
think
from
and
the newest Bad Boys movie, but he drowned in water, I believe.
spaghetti meatballs. Absolutely, arms are heavy. Love that. All right, here we go. Last question. Question number 20 is rolling an option out and up. A later expiration and higher strike is usually done too. Ooh, let's see if people know how to roll options. You know what? I'm glad that this is a question that's not like one of those easy layup ones that maybe people don't know what rolling options are, you know?
Yes. I yeah, I want you to explain this because I think I knew. Yeah, we'll see.
Yeah, so rolling an option out and up, basically pushing out a later expiration and higher strike, usually is done to extend duration, which makes sense. You know, you want to extend the duration of your stock option, whatever it is. So if you're selling a covered call, we talked about it beforehand. If you're talking about selling a covered call, essentially, you know, and say you want to kind of roll it up to get a higher, you know, appreciation of your share prices, you'd roll it out to a farther expiration date, which gives you more time in the duration. And it also reduces downside risk because there's more time for the stock to move in the direction you want it to go to, right? So you reduce the risk by rolling it, you know, and they say out and up, you know, if you're doing like a covered call, for example, or a if you're doing a bought option, you can do a bought call option. You can roll that one out and up as well if you're buying an option. And you move the strike price up, it actually reduces the risk because it'll actually reduce your cost basis. So, say, for example, like a $50 call option costs you $100, and then you want to roll it to a higher expiration or to a farther out expiration with a higher strike, you might roll it to a $55 one, but that one's going to cost you less than the 50 that might be in the money, for example. So it actually reduces your cost basis as well, if that makes sense. Ryan, I don't know.
Well, yeah, I guess I didn't know if you were talking about selling or buying when so you know that was the because if I was selling a covered call, let's say, and I'm rolling it out and up,
Yeah.
I didn't. I guess the downside risk was like, well, are you saying that because it's reducing my cost basis and technically on my shares? Like, I just didn't know what you meant by reduced downside risk. And I was going to say that to you this morning, but I was like, I think I know what he's saying, so I didn't know. But if you're buying it
Yeah.
and you went in the money and you rolled out
Buying
and
it, it's
up, you're
definitely, yeah.
securing profits, and I get you.
Yeah, and I'll tell you guys right now. First of all, if I tripped you up, okay, Ryan's question, he couldn't even explain it.
Hey,
Okay,
hey, hey.
so let's go
I
back to that one. All right.
I needed visuals, my friend. I needed visuals. It's a confusing concept already, and I need the visuals.
Yeah, it definitely, I mean, these are the questions where like you think it makes sense. Again, it's one of those things where it's like when you're a teacher, right? You think you can explain it well, you think you know the question well, and then for whatever reason, it doesn't come off maybe the way you word it, maybe for whatever the case is. I'm not really quite sure, but I wonder actually because if Mirage got it wrong
Yeah,
and Rock got it wrong, I wonder if
I
what's his
think
name snuck in.
it yeah, it could have been forward and moving up, but he said that Naomi and him got it right. So
Yeah. Question. So third place was forward. He actually, I think he was in fourth. He
he
made
was
it up
in
to the
fifth.
podium.
He was in
Congratulations,
fifth, so he
Jackson
moved up.
Smells in second and first place. Congratulations to
Mirage,
Itai Smells Mirage.
Mirage.
Oh, he was in fifth. Wow, he climbed up to third.
Yeah,
That's unbelievable.
that's good stuff.
said, "Hey, Taiwan." So guys, again, thank you all for tuning in. This was
Yes.
another fun trivia week, I think. And you know what? I love it when it's a close battle and not someone just taking away the entire thing.
Yes. No, it's
What
true.
about you?
It's nice when it's close, when we're down to the last question.
Yeah, absolutely. So again, we do these every single week. We try to always bring the knowledge every single week for things. And again, we're not perfect with the wording of the questions, so we do apologize if we get the question worded, a little bit off in this case. It does happen from time to time. But these trivias are always fun. We'll get to interact with people on the Kingdom Discord and people on YouTube. If you're watching it, again, you get a free week. Shout out to Ryan on his what is it? On your what? WAP? You get a
WAP.
free
Yeah, I
week.
think that's how you pronounce it as a WAP.
Yep, and Gio, yes, we do this every Saturday night, 6 p.m. Eastern time. So if you would
Yep.
like to take part in it, if you have some time built into your busy schedule from buying SoFi options and stock, you want to take some time away, you're more than happy to obviously join in. 6 p.m. We usually announce it on Discord, and you'll be able to have access to it and the live trading options here for usual for everybody. So people on YouTube, thank you so much for watching. Ryan, any parting words before we log off for the evening?
No, congrats, Mirage, and that was a fun time as always.
Absolutely. And I do not do 2 months of homework. That is not an option, Tyler. Thank you for the offer. I will not do that.